Good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Friday, August 19th, 2022. And our top story today, foundation investment choices potentially lose $20 billion for grantees. Well, joining me now to discuss this and a lot more, John Seitz is the Chief Executive Officer and founder of FoundationMark. John, so great to see you. Thanks so much for joining us on the program this morning.
Thank you, Jeff. Thank you for having me on.
We're going to talk foundations today, and I want to get into the definition of foundations in a second. But first, just tell us briefly who or what is FoundationMark?
Sure. FoundationMark is a website. It's also it's a company that is devoted to understanding the investment performance of private foundations. And there are about 100,000 private foundations in the United States that control about $1.1 trillion. You've probably heard of some of the largest ones, like the Bill and Melinda Gates Foundation, the Ford Foundation. Those are obviously the 500-pound gorillas in the sector. But there are, as you can imagine, with 100,000, a lot of smaller ones. We track the investment performance of the top 40,000 of those, which are foundations that have over $1 million in assets. And that represents about 98% of all foundation assets.
Yeah, that's a lot of data to track. And we'll get into that in a couple minutes because I know you and the team analyzed some of the investment performance. But before we do that, a lot of us have heard about endowments. We've heard about pensions. These are large pool of assets. What exactly is a foundation?
Sure, great question. They're often actually foundations and endowments are often put together in the same bucket because there are some similarities between the two. But the greatest distinction between a foundation and an endowment, for example, is that a foundation is a pool of money that is that needs to distribute 5% of its assets every year to operating charities. So when you think of an endowment, for example, a college endowment, that exists within the institution, and all of those all their charitable giving goes within that institution, versus a foundation. If you take a look at the larger foundations, they again need to distribute 5% of their assets, and they will fund various things, museums, education, things like that. The way that foundations typically come to life is there will be a family or an individual who will donate a lot of money to his or her foundation, and there's an associated tax shelter from that. And then the quid pro quo for that is that money needs to go out to operating charities over the life of the foundation.
And the key here is that a lot of smaller charities rely on these foundations for grants, for donations. And so this is a critical part of the infrastructure, if you will, for charitable organizations around the country.
You're absolutely right. The private foundations provide about 17 or 18% of all charitable giving. And that number has actually been on the rise as individual giving has come down in terms of overall charitable support. And one of the things that's actually been helping the private foundations increase that is the strong investment returns over the last decade. So the foundations have gotten a lot larger in aggregate, and therefore they are putting more money out there. The foundations put out about close to $90 billion a year in charitable support.
That's amazing, and obviously it's great to help so many people. John, you mentioned investment returns, and I want to get into the report, the analysis on some of the analysis that you and the team have done. But how generally are these foundations invested? Are they invested in traditional stock and bond investments, mutual funds, private market investments like hedge funds, alternatives, private equity? How do they typically allocate their monies?
Mm-hmm. Interestingly, it's all over the map. And so, again, we track 40,000, 45,000, and we look at their asset allocations. And there's cash, fixed income, public equities. that combination makes up probably 60% of overall assets. But on an individual basis, the numbers can vary from 100% equities. You'll see, in fact, the second largest foundation in the United States is in one single stock, the Eli Lilly Foundation. It's all in Lilly stock, which makes sense.
Yeah.
So that's an example of a foundation's all in one. But you've got other foundations like the Ford Foundation, for example, that has a diversified portfolio, a lot of alternatives, a lot of private equity, a lot of hedge funds, and then everything in between. So some foundations actually run a lot of cash if they think that they're going to be, winding down, or if their funding requirements, call for, checks to be written over the next several years. They want to be in lower volatility things. So it can vary all over the map. And it's one of the fun things actually about tracking foundations is exactly that, to see what's working, what isn't working, and and again, to have the ramifications of what's then, how much money is going to be actually flowing out to charitable organizations.
And John, last question before we go to a commercial break, and then I want to pick up the investment conversation in the second half of the interview. These foundations, especially the larger ones, have teams of people that do the due diligence. So it's not just a guy like Jeff Snyder. And by the way, there's no Jeff Snyder Foundation. Not yet. You never know.
I'll look in my database.
Yeah, you look in your database, it'd be the big goose egg on that. But there are teams of people that have the oversight. It's almost like the fiduciary role or a board of trustees that have oversight of how this money is managed.
Yes, absolutely. And as I said, foundations have very different strategies across the board. And a lot of the large ones do have an investment team. They have internal chief investment officers that work for, again, the larger ones that we're talking about. But once you get down to the 500 million and below, then there might be outsourced chief investment officers, or there also might be just individuals doing it themselves. There's there's lots of different ways to approach managing these pools of assets.
Yeah, well, and that's why you're here, and that's why FoundationMark exists. John, I want to take a quick break. When we come back, we'll talk about investment performance during the first half of 2022. I think you're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. We're talking foundations this morning. Joining us is John Seitz. He is with FoundationMark. John, thanks so much for sticking with us this morning.
Of course.
All right, so it's been an interesting year, to say the least, in the general stock market. A lot of volatility. We've got rising inflation. How did foundations do in terms of their investment performance? I know a lot of people look at their 401k, look at their pension plan. They're a little mixed right now, but how did the foundations generally do?
Our projections in the first half are that foundations fell 16.5%, and that, of course, is dragged down by the S&P, which is down 20% in the first half, and then international markets were also weak, and bonds, which traditionally have been a nice defense measure, those were down over 10%. The Bloomberg Barclays aggregate. So there was nowhere to hide in the first half. And so foundations, like most large asset pools, definitely suffered.
Yeah, I think a lot of us feel that way. We're feeling the effects of inflation. John, what does this mean for the grantees? What does this generally translate in periods of high volatility and market downturn, which we're experiencing, although the last couple of days have been pretty good, I guess, last week or so in the stock market. But what does this mean in terms of writing those grants, in terms of philanthropy, in terms of charitable donations and charitable grants?
It's a great question, because this, it's an often misunderstood element, which is that most people in the charitable world are familiar with the 5% payout rule, and they think that that's exactly how much goes out, and you would think that there is a one-to-one relationship. If the market goes down 10%, then grants would go down 10%. That's not, in fact, the case. Most, again, the larger foundations tend to do a 3-year rolling average of their assets, and so the last couple of years have been so strong that there's let's put it this way, the momentum on giving has been going higher. So even with foundations down 16% in the first half, we're projecting, if markets stay where they are, flat to slightly up contributions, charitable grants in 2022. Of course, you never know if markets are end the year up, down, up 10%, down 10%, then you will probably see some adjustments in that direction. The other thing, just to add, is foundations actually give out about close to 8% of their assets every year, not the 5%. Again, often misunderstood, but as I said earlier, foundations are giving out about $90 billion a year on a base of 1.1 trillion. So you do that math out and you get to 8% or a little higher, depending on numerator and denominator.
Yeah, I mean, sorry, I didn't mean to jump on you. I just want to say, I mean, it's a significant amount of money flowing to these charities. And also, unless you're winding down your foundation, you don't want to pay it all out in 1 year. John, do they, like a pension fund where they're writing checks every month for annuitants or retirees of a pension plan, is there an amount of money that is kept in short-term treasuries or cash to do that? How does that operation typically work? Again, generally, because it's going to vary. Like Eli Lilly, if they have 100% in Eli Lilly stock, I'm assuming they're going to have to sell some of the stock in order to raise cash. But generally, is there an allocation to cash or treasuries that they use to pay these short-term grants and payments?
Yes, but it's relatively small. And the if you look at the overall asset allocation of in aggregate, I think that the cash number is probably 2 or 3%. It's not a big number. And again, if you think about the overall sort of portfolios of these, if your liability, for lack of a better expression, of paying out 8% or whatever the number is, then you don't need to keep an awful lot of cash on hand, in order to have a great deal of comfort that you will be able to make good on your charitable commitments. And just one thing to add on is, especially on the larger foundations, they will typically fund things over a number of years. It's not just write a check one day. They will find a project or something like that, and then they will have multi-year commitments. And so they do try to match the asset and liability to that to some degree. You don't want to be caught short saying, oh, I'll give you $200 million over 5 years, and then have the markets go horribly wrong. And then you'd have to really scrape together to get that money. And as you pointed out, that the operating charities really rely on this. They need to get their budgets. They're thinking a year, 2, 3 years out. So it's an important dance between the two. But again, your question about, do they hold a lot of cash? They don't.
Last question here, John. And when you look, I'm not going to put you on the spot in terms of what's going to happen, but the Federal Reserve has told us that they could raise rates in order to clamp down on inflation. What does this mean for those that are managing these foundations, or they're outsourcing their foundations? What are things that, as you're tracking this environment, this ecosystem, you're going to be looking for vis-a-vis through how they're going to manage the second half of the year? What are some of the key things they need to be thinking about potentially?
Well, one thing that has been happening over the course of years is, there's been an increase in alternative investments. So you've seen, that overall asset allocation increase. And I think that has been driven by obviously strong returns in private equity. Hedge funds have not been a great a place to be over the last 10 years compared to public markets. But I would imagine that some foundations might be looking towards hedge funds as a place to look for some lower volatility returns than being exposed to public market volatility. Mm-hmm. And as I said, overall the alternatives have been increasing, and so those are typically not just a reaction to a 6-month time period, but longer term periods as they have long lives.
Yeah, John, I lied and I said that was the last question, but it's not. I want to ask you real quick, one of the big topics on our network, and I think that's talked about in general, is sustainability, ethical investing. How has that permeated into what you do and what foundations are doing? I would imagine, given the charitable nature of the organization, the philanthropic nature of the organization, that this is, diversity, equity, inclusion, and other types of things are top of mind for many of these managers.
That is true, and there's been a lot of talk about ESG investing and a lot of the associated topics as you touched on. But one of the things that we think that we provide is we provide a base case, because since we track the entire investment world of foundations, then you have a bogey to aim against. And so there's measuring ESG returns. One of the questions people usually have is, oh, if I invest differently, if I reduce my opportunity set to just ESG or to sustainability, how is that going to affect our returns versus if we have the whole world of investment opportunities? And so the things that again that we provide is the entire foundation universe. So if you were thinking about doing this, if you want to measure yourself against it, if you want to see after 3 or 4 years, have we done compared to the other foundations? Again, I think we provide that tracking bogey, the benchmarking, the tools that foundation trustees can then evaluate their performance and see if their ESG has had, just in terms of financial impact, to see the financial impact separate from the good that they're doing.
Yeah, it's always important to benchmark not only the underlying funds, but also benchmark yourself against your peers. That's something that happens in the endowment world, in the pension world, and apparently also in the foundation world. John, we're going to leave it there. So great to talk to you. Thanks so much for joining us, and we look forward to having you back on the program again very soon, my friend.
Thank you, Jeff. I really enjoyed it, and please, love to talk to you more.
Well, that wraps up this episode of BRN AM. Have a topic of interest, somebody you think we should talk to, drop us a line. And don't forget, for all the latest security news and lifestyle wellness, finance, tech, so much more, and all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives, check out our latest content? We'll visit our website and our streaming partners. We're back again tomorrow for BRN Weekly. We'll be taking a look back at some of our best segments for the week. You're not going to want to miss it. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Waiting here for you to take and drink of. But if you're tired, come on.
Now is your opportunity to co-create content around any topic on the first lifestyle and wellness network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.